evening, TheoTrade. This is Corey Rosenblum, and you're watching the Theo Nightly Video for the 11th of February here in 2021, and we're still waiting for that pullback. Got a little bit of a movement to the downside on Wednesday, and that was followed up a little bit more on Thursday, today's session, but the buyers stepped it back into the close the last 2 days. So we are still watching for that pullback, planning and getting our delta negative. More so holding delta negativity in the probable pullback yet to come. So markets are rarely, certainly possible, but rarely do they go straight up. They typically wiggle and squiggle, which is a fancy word or unfancy word for retrace. They trade to the upside, they pull back. They trade up, they trade down. And that's how markets cycle. So right now we're in the overbought position. What we're looking at is the volume profile logic for the S&P futures. Think of this as a standard or normal distribution. So a market into or above does have better odds. Think of it like this right here. For the market to pull back. Pull back where? To the midpoint or the mean. In this case, the middle of the profile. There's various different profiles you can use. I'm just choosing to use the volume profile. Same on a TPO. These are standard indicators in thinkorswim. But the main idea is something overbought or at the top of the distribution does tend, certainly not guaranteed, but does tend to trade back down. And something that is beneath the lower value area extreme does tend to trade back bullishly, back inside the profile and to the midpoint. All that being said, that's the framework with which I'll use for the first part of tonight's video. So there is the S&P with a profile on the pullback plan. There's the Nasdaq with some room to the downside, the Dow mini futures, and the stronger than normal Russell. All these can be discussed or seen on the ETFs, SPY, QQQ, DIA, and IWM. On the other side is the bond market. We have the same logic, the same type of profile and probability. Now it's the exact opposite because as stocks have been going straight up, the bond market, I'm showing TLT in this example, has been trading down. So it is on the lower bound of the probability distribution and has good odds to rotate back higher. That's the trade, that's the play, and that is creeping its way to the upside and profitability. The main idea, cutting through all the lines and the charts and everything else, bonds have a good probability to continue rotating a little higher, bullishly, and stocks have a good probability short term, not talking 3 months from now, but through the holiday and through the next week, to rotate a little lower. If you are a bull trend trader, you might want to get your positions put on a pullback on the next swing lower. So that's where we are. That's it. Market's going up. Market is overextended. And the probability is for a pullback. That can be done with probability or profile logic, volume distribution, and any number of components. Just simply trading or playing or expecting mean reversion. What is the mean? Mean is the average, and that is usually the middle of a trend. So if you are a bull and expecting the market to go higher, this is not your time to get long. That is on pullbacks or these red bars or as price moves toward the rising average. Well, that's done, that's finished. We are waiting for a pullback. If you do not wish to trade short, then wait for the pullback to take its time, ideally quickly, but the patience on the pullback. Any number of examples shows the market can fall, and that trends to trade a little lower to these averages. That is true in the Nasdaq. Right? So even though we're going up, we don't go straight up. We wiggle, squiggle, or retrace. And to the extent that we go a little too extended, like a rubber band being pulled too far, the market does tend to snap back very quickly. And that's 1, 2, 3, 4, 5, 6, 7 days up, and then a snapback. That's multiple days to the upside, and actually multiple weeks to the upside. But that was all erased within about 4 trading sessions. So that's the point. That's where we are. It is far too late to be long in terms of swing trades. The strategy is to wait for this pullback or take part in the pullback. And that would play out in any number of stocks. And the bond market continues to trend downward as the equity market goes higher. That makes sense. That is the inter-market relationship where the weakness in bonds tend to go alongside strength in the equity market. And the same logic, even though the bond market, again, looking at TLT, we could easily look at IEF or just the bonds themselves. They are downtrending. They are continuing to make lower lows and lower highs. They have falling moving averages, but they don't go straight down. They too wiggle and squiggle. So in the direction of the trend is where we look to put on the positions. That's considered trading with a trend. Trading fades or bounces or movement against the trend, that's considered contra trend or counter trend, and has its own benefits and merits. We're at that spot where the bond market has decent odds to rally up, and the equity market has decent odds to fall down. But again, that's based on the intermarket relationships and money flow between the bond market and the equity market, all things being equal. This will be true in individual stocks as well, or leading ETFs, including the financial sector XLF. The last time we were up at this $31.40 or $31 and about 50 cents per share level was earlier in January ahead of a multi-day pullback. So these down moves, we call them pullbacks or retracements, and that is next in terms of probability. Now, can the market easily break to the upside? I would not say easily break, but certainly is possible. Not probable, but certainly possible. And any number of stocks as we look at for positive trends or uptrends would play into that dynamic. But as we go through into Friday and this holiday weekend, there's where the market stands. Continual uptrend, higher highs, higher lows, strong rally, strong stocks. But like anything, 1, 2, 3, 4, 5, 6, 7, 8, 9 days in a row to the upside does not tend to result in 9 more days to the upside. The probabilities for a pullback and any number of metrics would suggest that. Not guaranteed, but certainly probable, and that's all we can do as traders, is play the hand that we're dealt, play the market that we're dealt, and the trades that come from that perspective. As always, be careful and safe. This is Corey Rosenblum with tonight's Theo video update for February 11th, 2021.